Risks of investing in IPOs. What you must know before entering fully participating in an IPO may seem like a golden opportunity to get in on a potential stock at a low price. But in reality, an initial public offering is not a surefire way to make money. There are many hidden risks involved. If you encounter a new stock that performs worse than expected, not only will you fail to make a profit, but it may even drag down the performance of your entire investment portfolio. First of all, we need to pay attention to the risk of withdrawal. Even if you have applied for subscription, if the international placement is undersubscribed, the company may cancel the listing at the last minute. This situation occurred many times during the SPAC special purpose acquisition company boom in 2022. SPACs, often referred to as blank check companies, raised billions of dollars during that period, with investors lured by the promise of merging with a high-growth private company and taking it public. However, as market conditions shifted and regulatory scrutiny increased, many SPACs found it difficult to secure suitable merger targets. When international investors lost confidence and pulled back, numerous SPACs had no choice but to abort their listings, leaving retail investors who had planned to participate in the IPOs disappointed and with their investment plans disrupted. Secondly, it is not uncommon for new stocks to break issue I trade below the offering price on the first day of listing. Take the Hong Kong market in recent years as an example. Approximately 30% of new stocks fell below their offering prices on the first day of listing, which is a significant blow to short-term investors. Short-term investors often enter the market with the expectation of making a quick profit from the initial price surge that many IPOs experience. When a stock breaks issue, they not only miss out on the anticipated gains but also face immediate losses. For instance, in 2023, a number of technology companies listed in Hong Kong saw their share prices drop by more than 10% on their first day of trading. This kind of performance can have a ripple effect, as investors who suffer losses may be forced to sell other assets in their portfolios to cover the losses, further impacting their overall investment returns. Another concern is the concentration of shares phenomenon, which is particularly common in penny stocks. If shares are overly concentrated in the hands of a few investors, the stock price can be easily manipulated, leading to exaggerated rises and falls, which poses extremely high risks. Penny stocks, typically with low share prices and small market capitalizations, are more vulnerable to such manipulation because they have lower trading volumes. A small group of investors can accumulate a large number of shares without attracting much attention. Once they decide to sell off their holdings, the stock price can plummet drastically. Conversely, they can artificially inflate the price by buying up shares in a coordinated manner and then sell them at a profit, leaving other investors holding worthless stocks. This kind of manipulation is not only unethical but also illegal in many jurisdictions, but it is still difficult to detect and prevent completely.